Good evening. I'm your anchor with AI Capital Brief, and today we look at Bitcoin, where it is now, and where it might go. As of today, Bitcoin trades in the ballpark of $87,000, well below its October high near $126,000, but far above levels many investors consider a reset zone. That puts us at a crossroads. Some see a slide towards $60,000 as plausible, while others believe structural shifts could carry it all the way to $250,000 or more. Let's break down both scenarios. First, liquidity and institutional flows, once one of Bitcoin's strongest supports, have recently weakened sharply. US-listed spot BTC ETFs have recorded billions in redemptions since early November. For instance, the largest Bitcoin ETF, iShares Bitcoin Trust, logged a single-day outflow of $523.2 million, its biggest redemption since launch. Meanwhile, analysts at Citigroup have warned that with ETF demand drying up and long-term holders becoming more defensive, Bitcoin could drift toward their year-end bear case of roughly $82,000 if no fresh institutional money returns. On top of that, some market data suggests that demand might now be failing to keep up with fresh mining supply. That breaks the core supply constraint narrative many bulls rely on. Against such a backdrop, weak demand, outflows, macroeconomic uncertainty, and fragile sentiment, a slide to $60,000 could be a realistic stress test scenario, especially if an external shock or broader risk asset sell-off hits. On the bullish side, supply dynamics remain structurally favorable. The most recent halving in April 2024 sharply reduced the rate at which new coins are mined. Economists and crypto analysts argue that if demand holds stable or grows, such scarcity should support a significant price appreciation over time. Indeed, in 2025, demand from both institutional and corporate buyers reportedly outpaced new supply by a wide margin. At one point, demand was roughly 6 times the newly mined BTC. That kind of imbalance, if sustained, can create powerful upward pressure. Moreover, the emergence and popularity of regulated spot Bitcoin ETFs have mainstreamed access for large pools of capital, pension funds, endowments, corporate treasuries, many of whom now see Bitcoin as a legitimate asset class. That broadening of the buyer base introduces a major tailwind to price. If institutional allocation continues to grow, say, a small percentage of global investable assets flows into Bitcoin over time, the result could be a market cap explosion far beyond previous cycles. Combine that with scarcity and the conditions that could support a move toward $250,000 begin to materialize. Finally, unlike earlier cycles, dominated by retail FOMO, this potential rally would be rooted in structural demand, long-term holders, institutions, treasury allocations, and broader adoption of BTC as digital gold. That suggests the $250,000 scenario isn't purely speculative. It's a plausible extension of current macro and structural trends. Of course, neither outcome is guaranteed. The downside path depends on continued outflows, fading institutional interest, macroeconomic shocks, or regulatory headwinds. On the flip side, the bull case assumes that demand remains robust, adoption continues to broaden, and no systemic shock derails confidence. Importantly, some analysts argue the post-2024 halving price appreciation may not follow prior cycles so neatly, because the market dynamics today are fundamentally different. Today, Bitcoin sits in a gray zone, too high for many to call it a bargain, yet possibly too fragile to rule out a meaningful drop. If institutional support weakens further, a test of $60,000, or at least a retest of sub-$70,000 levels, is within reason. Conversely, if demand holds and continues to grow, bolstered by structural adoption, scarcity mechanics, and a new generation of large-scale buyers, $250,000 remains a realistic, albeit aggressive, outcome over the medium to long term. As with every asset, the trajectory will depend not just on price cycles, but on investor behavior, macro conditions, and adoption. And that's where we stand tonight. I'll continue monitoring the flows, miners' supply data, and institutional activity, because in the world of Bitcoin, the difference between $60,000 and $250,000 may come down to just a few decisive shifts in demand. Thank you for watching AI Capital Brief. Please stay tuned for your next episode.